Well, hello. This video may come as a bit of a surprise as I haven't really been covering the housing market at all on this channel. I've been covering different stock indices, some commodities, and mainly cryptos. But one cannot help but notice there's some correlation between the stock market's movements as well as that of the housing market, real estate, bond market, commodities, and even cryptos. And if there are correlations with those asset classes, then Elliott Wave theory may help us make at least somewhat of a forecast, at least gain some clarity on where we're going. So we're going to go over some of what we're seeing right now. The Case-Shiller home price index, which I have displayed right now. This is actually the St. Louis Fed's own website. So this is straight from the government resources right here. And then also go over some of the anatomy and the timing of some of these housing crashes. But I got to admit, there's crazy housing euphoria. Many of my viewers that are watching right now, you guys have been involved as well. Maybe you've put in some bids, you've paid some breathtaking amounts for real estate, whether it's for investing or living in. And well, this is the sign of euphoria without any question when people are going crazy buying houses just because. We can justify it with all sorts of rational reasons, but oftentimes it's just sentiment. And it's not just housing. We see it in cars. We see it in the stock market even, although it hasn't felt like that the past few months. But this is a closer look at the index. And you can see how we had our initial housing bubble back in 2006, and we pulled back down in 2012, and we've been going up ever since at breakneck speed. These gray areas are highlighting where we had recessions. They actually have the March 2020 recession here. It's actually marked, well, it ended in April 2020 based on the government metrics. And look at that parabolic blow off top. It just went nuts. And well, let's look at it this way. If I'm not mistaken, this is a normalized chart. So our index was about 136 at the bottom, and we are sitting at about 289. So yeah, we've more than doubled from the bottom of the housing crash after the great financial crisis. So that's what this index shows. I'm actually going to switch over to my trading view chart, which actually does have that available. This is, of course, the S&P 500, which we're going to go over in a second, but I do have access to this in trading view. And we can actually do some Elliott Wave analysis, which I'll go over momentarily, but I'm going to go over how the S&P moved actually first. So this is a weekly chart, and well, we are way up on top of the mountain at the moment. This is the great financial crash in which we had a colossal calamitous pullback into 2009. It started at the towards the end of 2007, and in Elliott Wave theory, this entire stretch here that's right. It was a flat correction. So the entire decade from April 2000, whenever the top of the dot-com bubble was, all the way to our bottom at the end in 2009, A, B, C, big flat correction. The entire thing by Elliott Wave standards was a bear market, even though it may not have felt like it. There are other indices in which we didn't make a higher high. But looking at this chart, one would assume that our housing top happened about here, September 07. That's what we hear. That's what a lot of us remember. And maybe it's a Mandela effect. I don't know. And we had a crash, right? And I think many of us are aware that the housing crash took a few years. It didn't bottom until what, 2011, 2012. Well, here's the crazy thing. Our market top was in 2007. And when we look at our actual, our data from Fred, housing top again was actually about 2006. We actually went into about winter, early spring 2007. That's when our top was, but our market didn't crash for about 6, 7, 8 more months. So I had mistakenly assumed that housing crashes usually happen after a stock market crash. Stock market crashes lead housing crashes. That's what I thought, but it turns out it was totally the opposite. We didn't see that at all. We saw the housing crash happen first. So that's an interesting thought. Does history repeat itself? Not always, but it can often rhyme. So that is number one thing. Number two, well, we had a bottom in 2012. When we look at our S&P 500 in 2012, there was a lot of shakiness there. If anything, this could have been a wave 2 bottom, although we didn't really see that same pullback until a little later. So maybe a smaller wave 1, wave 2, something like that. But you see again where the stock market and the housing market didn't perfectly align. And we've been rocketing up ever since. Now, we had this crash in March of 2020, and we look at our Fred data, no such thing. I know there was a bit of a crunch. There were a lot of contracts that people backed out of right as the pandemic lockdown started, but we haven't really seen at least anything on this chart to that effect. So that is what makes things interesting here. So when I go back to our Case-Shiller, as I'm promised, I can put Elliott Wave markings on this. So before I jump too far ahead, I am showing that I have a 3, 4, 5 here. I'm going to go back to my Dow chart. I believe that's the one where I had the most clear pattern. Well, there's actually a lot going on here, but I see this as a fourth wave down. And this is actually the same situation in cryptos and a lot of other asset classes in which we had a major fourth wave, which is the penultimate correction before the big one, which would lead us to believe that we have at least a fifth wave left. However, because the housing market seems to be leading, well, maybe we may be close to the top than we might think at first. So looking at this, I know this data doesn't go back as far as the Fred data does. So I basically extrapolated and set our base at about $64. The Fred data only goes so far back. So I assumed a very standard 38.2% retrace from our top in 2006. So that top sits at about, it was at 206 on this chart, fell back to about 133. Based on that, the equivalence, again, if you followed my channel, we often see a fifth wave extend to the 0.32, 0.5, or 0.618 extension of a larger 3-4. If that is the case, well, we are quite overextended at the moment. You see this thing flashing up here. This is actually what we call the pivot zone in our analysis and our methodology. So if you break to the 0.764 extension and stay above the 0.618, that's a very good indication that you're in a bigger third wave or something. So yeah, there's a chance that the housing could continue to go up exponentially. A lot of people believe that will happen because of the scarcity of housing, because of the mania, growing population, whatever you think it is. However, our analysis is kind of giving us some clues that that might not be what's happening. We're already overbought territory at the moment. And if you extrapolate what we already have here, I've put some channel trend lines here, and this is just a linear extrapolation. If that is the case, if we get to the 0.764 extension overhead at 328, that's about a 10 to 11% increase from where we are right now. So again, right now the momentum is still upwards in the housing market. So maybe we have a little bit more juice to squeeze. What was that saying? Markets can remain irrational longer than you can remain solvent. That's a warning towards people that are perma bears, people that short constantly. So if you're looking for a housing crash, don't expect it right away, but it may come sooner than you expect. Now, if that is the case, we do have, again, this is an arbitrary projection of where we could fall in the index, and these labels don't indicate anything regarding timing. I just placed these here in terms of price levels. But when we look at the fibs, we often see the correction get to about where the fourth wave was in the previous rally. So we could see house prices get back down to about where we were at the bottom in 2012. And of course, if we saw something like that, if this really does follow Elliott Wave patterns, I would expect to see a 3-wave correction, so an A, B, C. So it may not happen in one fell swoop, and it may take several years. However, if we do fall from where we are at present day, eventually this could be a 60% housing crash purely based on Elliott Wave theory. Again, I don't have enough history to project this appropriately, but looking at where we are in our cycle and the fact that at least housing seems to be ahead of stock markets by at least a few months, maybe a year or two, whatever it is, there's reason to believe that this could be where we are. Now, I did mention we could go a little bit higher, about 10% higher. If with this linear projection here, just literally a linear trend line following the latest curve that we've seen, that places this top around April of 2022. So yeah, well, not April of 2022. This would actually be a little bit further out. But point being that we're actually close to the top than we may have otherwise thought before. So with that being said, what do we expect to see after that? Well, you're going to start seeing some evidence. Obviously, we've had that mania, but there's already evidence that in some of the bubble real estate markets on the West Coast that we've seen a reduction in the list prices. I follow a channel called Reventure Consulting. Very interesting hard data. Now, I don't fully agree with everything the gentleman says, Nick, but he does have some actual report data that shows what the listings are, things like that. There's also concern that there may be an explosion of supply because we have a lot of construction permits, a lot of houses that may come on the market. And there's also the thought of high interest rates maybe deterring people from buying houses. But as far as I can tell, there's still a mania here in Texas. And if you've looked around, not just YouTube, but social media apps, things like that, get rich quick schemes are still quite prevalent in the real estate space. There's a lot of classes, courses, a lot of hype behind either flipping houses or getting in investment properties. So those are all just me speculating, yelling at the clouds. But again, from the Elliott Wave perspective, we do have some interesting correlations. Final thing, I'm actually going to add the S&P onto here, S&P 500. This is what our correlations look like. It just froze the hell out of this. I don't know what's going on here, but you can kind of see how this was, wow, this was the third wave top for our housing market. There was a B wave top for the S&P, and then there was some correlation, some coincidence here between the bottoms, although housing bottomed a little bit later. So the crash started earlier and it bottomed later. It could be reflective of housing being a less liquid asset. That's something you'll hear quite often. And while I do think we have some more juice to squeeze from the S&P 500, the same may not be true for housing. So again, this is just pure speculation. This is not financial advice. I will very likely be covering more on not just housing, but other asset classes throughout the markets in the US. So stay tuned, subscribe to my channel if you haven't already. And until next time, happy speculating.